How can the IRS come after me personally for payroll taxes? I'm a partner in a company that is bordering on bankruptcy. My partner's paid employees instead of the payroll taxes. How can I get out of this mess that my partner's put me in?
This is an interesting question, and it's also a very common scenario. When a corporation starts to decline and is unable to cover its necessary expenses and business overhead, oftentimes the lender of first resort becomes the IRS. If a corporation doesn't make its federal tax deposit and pay its payroll taxes to the IRS, it oftentimes takes the IRS 6, 9, 12 months to catch up to the corporation and say, look, there's a delinquent payroll tax liability. The problem here is that payroll taxes are a very dangerous tax to owe. And the reason why is because the owners of the corporation that accrued the payroll tax liability can and most often become personally responsible for a portion of the unpaid corporate payroll taxes. And the amount they become personally responsible for is usually about 2/3 of the total tax. So if the corporation has, 10, 20, 30 employees, the payroll tax after, 6, 9, 12 months might be a couple $100,000. That means each owner of the corporation can be personally responsible for, upwards of $130,000 of tax. And the tax they become personally responsible for is not just chargeable in bankruptcy. So a corporate payroll tax liability might have really substantial consequences to the owners of the corporation. And what happens in many, many cases is that one corporate partner is handling the business affairs of the corporation, and the other corporate owner is handling marketing or other aspects of the business. And so one corporate owner may not know that the other corporate owner hasn't paid payroll taxes for quite some time. In order to become a responsible party for personal responsibility for the unpaid corporate payroll taxes, the IRS has to prove two things to assess that tax against a corporate owner. First, the IRS has to prove that the corporate owner had the authority to determine which creditors got paid, including the IRS. And the second thing the IRS has to prove is that the corporate owner was aware of the tax liabilities as they accrued. Oftentimes in this environment, what we're seeing a lot in my law firm is we're seeing a lot of corporate owners embezzling from the corporation. In essence, they're taking money out of the corporation to cover their personal expenses without the other corporate owners knowing about it. So in this type of case, what this partner needs to do is, first of all, since the corporation is still in business, and that's a good thing, would be to devote as much corporate assets and resources directly to the unpaid payroll taxes, and the corporate owners can apply their payments of unpaid corporate payroll taxes to the trust fund portion, the portion that they would be personally responsible for. They could designate where they want that payment applied to. So if this corporation owes a couple $100,000, if they designate a $130,000 payment just to the trust fund portion, the portion they become personally responsible for, then that amount's paid. They wouldn't, even if the corporation fails, they would be personally responsible for the taxes.
Well, and Sam, we get a lot of inquiries from people in corporations, partnerships, LLCs, however they're set up. So folks understand that if a corporation does fail, there are corporate income taxes that can go away in a bankruptcy, but that portion of the payroll taxes that is held in trust is not the business's money. That's the employee's money that the business holds out to forward to the IRS. And if you don't forward it, that gets us into a real serious problem.
Exactly, and that's why they call it the trust fund portion. If an employee is paid $100, the employer is going to withhold about $20 from the employer's paycheck and pay the employee $80 and keep $20 and add to that maybe about another $10 and send that $30 over to the IRS. The money that was actually withheld from the employee's wages was never the employer's money. It was always the IRS's money, and the IRS wants to make sure they can collect that money from the corporate owners, and that's why they apply that corporate payroll tax debt or a portion of it, that trust fund portion, directly to the corporate owners.
And it doesn't matter what form of business you're in. That trust fund account, that's critical. That will get paid somehow or another. That's the one that the IRS will go after you personally and attach bank accounts and do that sort of thing.
Absolutely. The IRS treats delinquent payroll tax cases very aggressively, and they take it very, very seriously. They're oftentimes the largest types of tax cases out there. A corporate income tax, where the corporation should pay an income tax, that doesn't become the personal responsibility of any of the corporate owners unless the IRS can pierce the corporate veil, which it usually doesn't even try to do. But for the payroll taxes, they'll really pursue it. And you mentioned that somebody will pay it. That's also not necessarily true. There are quirky situations where the IRS may determine that there are not any responsible parties, and we've seen some of those very unusual cases in our office. But taxpayers shouldn't rely on that quirky result to think they're going to get a tax resolution. If they get assessed, if a corporate owner gets assessed the trust fund portion, then they have to deal with the IRS as a collection division. And in doing so, they can then do a settlement for the tax liability, or they could do an installment arrangement, or they could do an offer in compromise. There's a variety of options after the tax gets assessed.